However, markets didn't give a thumbs up today. Markets were down 1,000 points. So my first question, and with me, so you most of you know me. I've been there with you guys through thick and thin, through ups and downs, through all the market cycles. And our idea at Ambit Asset Management is very simple: stay invested, stay focused, and bring out the best quality businesses which can accelerate in earnings terms north of 20%. That's the whole endeavor. That can we find gems, whether it is large cap, whether it is mid cap, whether it is small cap, across across market caps, fast growing businesses. And today we have come to have a conversation on a very interesting and important topic, which is hitting everybody's mind, which is questioning everybody's faith. A, where the markets are heading. B, are small caps overvalued? Should you get in or get out? Should you invest more or book profits? Are small caps overvalued, or still there's money on the table to be made? So with me, we have Bhargav. Bhargav needs no introduction. He has been with us for since 2010. He went to Kotak for a short while. He was enabling the Kotak small cap, and we have got him back. A precious jewel coming back home, strengthening the small cap research, strengthening the small cap fund management. So we are going to talk about the nuances of small cap today. So my first question, thanks Bhargav for sparing time from your busy schedule. My first question, Bhargav, to you is: markets of late have been very volatile. We are seeing steep ups and downs. Some day we see Sensex moving up by 1,000 points, and other day we see Sensex moving down. By no means we are in a cheap zone if I look at the historic PE multiples. At the same time, we are seeing that government companies which have never worked in the past are working fantastic. They have done extremely well in 22. Some of them have done extremely well in 23. What lies ahead of us in terms of macro? We are seeing heightened tensions in the Middle East. We are seeing Israel and Iran coming loggerheads. We are seeing Middle East becoming much more chaotic. And every day, when the deceleration of economy in China also worries us, because China contributes a significantly large portion to the world GDP, and China slowing down can be questionable from the world GDP perspective. Also, the US inflation from 3% moved to 3.4%, which is again worrisome, that the rates which were expected to be cut immediately may get postponed. So India is doing well, Bharat is doing well, but global geopolitical tensions, economic tensions, the angst amongst the nations, what lies ahead for us in 24 and the first half of 25?
So first of all, thanks, Siddharth, for inviting me to this, and good evening to the audience in general. So yes, Siddharth's question is fairly pertinent, that the markets have rallied a lot in CY23. In particular, small and mid caps, which have been the flavor of the year, rallying by almost 50% in CY23. Large caps have also done fairly well. But see, what happens is that in such kind of market environments where globally it is fairly unstable in terms of political as well as macroeconomic situations, we need to be relative as a market, because equity as an asset class will not lose flavor. So essentially, we believe that more and more flows will come into markets where you find growth, and essentially where you find a stable political situation as well as fiscal situation. So if you look at all these three boxes, then clearly India as a market looks like a oasis, sort of a desert kind of an environment where things are very unstable. Yes, valuations do look very expensive if you compare it to 5-year average. In large caps, if you look at valuations, then we are trading at about 21 times the FY24 earnings, as compared to a 5-year average of about 17 times. And if you look at small caps, then we are trading at about 25 times compared to an historical average of about 18 times. So clearly, I mean, both the large caps as well as small caps are expensive. But if you look at on a relative basis, then India is the market which is growing at double digit as far as nominal GDP growth is concerned. We have a fairly stable government, and after what happened yesterday, it seems almost 100% that we'll have a stable government as far as May 2024 elections are concerned. And if you look at the fiscal discipline as well, we are on course to have a very stable fiscal deficit situation as well. So to that extent, we clearly believe that this is a decadal opportunity for India. In fact, if you look at from a liquidity perspective as well, what happens is that if you look at US as a market, the mutual fund AUM as a percentage of GDP in US in 1987, which was at about 11%, in 2000 it became as high as 70%. And US was in a secular bull market as far as the 1987 to 2000 period is concerned. So if you look at India to that context, in the last 4 years, in India also mutual fund AUM as a percentage of GDP has gone up from about 10.9% to 17%. So clearly we are on that roadmap of what we saw in US during the 1987 to 2000 period, replicating in India as equity as an asset class finds more and more favor, and more so in a country where the percentage of cash transactions are declining. And to that extent, if you compare returns of equity to maybe a real estate or a land or a jewelry, you will find equity as an asset class becoming more and more attractive. So I believe that whilst valuations are expensive, if the market continues to see growth with a fairly decent balance sheet, then obviously this valuations are here to stay. So any sort of an opportunity like today, where you saw a correction, can actually be used to sort of average down, is what my understanding is.
So very, very interesting perspective what Bhargav gave. Number one, valuations are not cheap. If I look at the small cap valuation, they may be trading at roughly around 45-50% above their 5-year average. If I look at large cap valuations, they are trading at around 25 to 30 odd percent above their average valuations. Despite that, there is money to be made. Why? Number one, earnings are much more robust, earnings are much more consistent, and India is standing tall because of a rapid and high growth rate, because of which the global flows are getting in. That's number one. Number two is domestic flows in the form, as Bhargav spoke about, that US, the mutual fund industry as compared to the GDP is 125%. We are merely 17%. So there is increasing inflow from the mutual fund, which is domestic investors. Number three, he spoke about digitization. He spoke about financialization of savings, and because of which the tier 3, tier 4, tier 5 cities are participating in the investment cycle, in the financialization of savings and investments. And that will clearly, the flows, the relentless flows, will make sure that India's trajectory remains north rather than south. To the conversation, a very, very interesting perspective you brought, Bhargav, that things are not cheaper, but still look positive. Still, there is headroom for money to be made. And as Bhargav rightly said, use these dips, use these meltdowns, so-called minuscule, minute meltdowns, to buy in rather than get worried about it. So that's number one question. Second question, Bhargav, is specifically about the small cap. Let's dig deeper, because this is the space which has made maximum money in calendar 23, and if I have to specify in the second half of 23, it has just rocketed. If I may use the word, it has been very, very buoyant. It has been very, very running very, very fast. Keeping in mind where they are, and keeping in mind generally small cap denotes quick frothiness, poor quality, and huge amounts of risk. We have seen 2018 where small caps were beaten down 30, 40, some of them 60, 70% as well. 2019, 2020, and then 21 was good time for small caps. And then again, 22, we saw a little bit of tepidness. And then 23 was just like berserk. Aren't we in a bubble zone? And if the bubble bursts, everybody tells us that if the bubble in small cap bursts, the pain and the bloodshed will be massive. So, what's your view generally on the small cap space? Keeping in mind that some of the large small cap mutual funds have stopped taking the money in the fear of rich valuations. We know few of the mutual fund houses who have stopped doing it. What's your sense? What's your take on the small cap space in particular from here in a 1.5 to 2 year horizon? And let's not go for 10 years because investors want in next 1.5 to 2 years time frame.
So if you look at a lot of media articles, as well as there's a lot of noise on the street that small caps are sort of overvalued, and they are in a frothy kind of a zone. But what we sort of did was we looked at are there any fundamental or DNA changes which are happening in small cap companies. So what we did was we did some historical analysis in terms of how small cap companies have performed in the last 3 years. So we see three big data point changes which have happened in small cap companies, and I'll speak at the index level because it will give you a broad-based idea. So if you look at Nifty small cap 250 as an index, and if you look at free cash flow generation across FY20 to 23, what we see is that the free cash flow in the last 3 years has compounded at 51% over FY20 to 23. And if you look at FY17 to 20, this number was minus 16%. So what we are seeing is that there is a significant DNA change which has happened across small cap companies in the last 3 years, with significant free cash flow generation contributing to their balance sheet strength. And if you further break up what has led to this improving free cash flow, the main driver of this improving free cash flow is in working capital. And this reduction in working capital has been led by a reduction in inventory days. So what has happened is that the small cap companies have changed their supply chain ecosystem from earlier importing, which has a higher lead time of about 3 months, to now procuring raw materials domestically, which has reduced the lead time to about a month as compared to 3 months in the case of imports. So there is a structural argument that going forward, your inventory cycles will continue to remain lean. And that would mean that working capital might not sort of go back to the earlier elevated levels. So clearly, you see a structural shift as far as free cash flow generation is concerned. The second data point is that where has this free cash flow gone? So smartly, what small cap promoters have done is they have used this period of COVID to sort of rectify their mistakes. So they have taken a lot of leverage on their balance sheet. So if you look at FY17, the net debt to equity was as 1.4 times.
Wow.
So if your own capital is 100 rupees, your loans were at 140 rupees. So what has happened during the COVID is that these promoters realized that we are generating strong free cash flow. So why not use this to repay debt? So if you look at 2023 March, the net debt to equity has actually reduced to 0.2. Means that effectively these small cap companies are debt free. So that's the second data point which typically excited us. And these are behavioral changes.
in India, we are a fairly emotional sort of a country. And typically, behavioral changes take a long time to sort of again go back to the earlier behavioral patterns. And when we interact with a lot of these companies, they do tell us that they no longer want to sort of reliver their balance sheet back to the pre-COVID level. So this is a interesting second data point which we wanted to highlight. And the third data point which Siddhartha mentioned in terms of the global situation, which is sort of turning cautious, as he highlighted the war in Hamas, Israel, the war in Russia, Ukraine. If you look at small cap companies, export as a percentage of revenue, it is significantly lower as compared to large caps export as a percentage of revenue. So if you look at small cap companies, just about 16% of revenues come from exports, whereas for large cap companies, that number is at about 25%. So what I'm trying to say is that small cap companies in India are more domestically focused compared to large caps, which have higher share of exports. So clearly, in the event, if there is any significant global situation becoming unfavorable, then we believe that small cap companies are well placed to pass that headwind, given that they are more domestically run as compared to the earlier large caps, which are more export run. And what is also happening is that in terms of small sub pockets across small caps, we are seeing capex sort of rising significantly. So if you look at the last 3 years, the free cash flow generation was used for debt repayment, but the next 3 years, that free cash flow will actually go into capex. So an interesting data point is that while small cap companies saw 16% revenue CAGR during the last 3 years, the capex CAGR was just about 9%. And that has resulted into very high capacity utilization. So if you look at capacity utilization, that number is now at about 79%. And the historical high was about 85%. So to that extent, companies will have to incur capex. And now they have the ammunition as well to incur capex in the form of free cash. So my humble request would be that not to sort of compare multiples with historical averages, because if you do that, then you are comparing apple to oranges. The earlier small cap companies were debt ridden. They were sort of more revenue growth and less cash generating. But now companies are sort of debt free and more focused on cash generation. So the quality of the small cap companies has seen a significant improvement. So to that extent, the premium valuation also seemed to be justified. And if you sort of talk from a foreigner's perspective, if you look at the market cap bucket for small caps, the first company in small cap is no longer small. It's almost a $3 billion market cap company. The 251st company I'm referring to. So from a foreigner perspective, it becomes that much more easy to deploy capital because the $3 billion market cap company would also have ADV, which is the average daily value in excess of $2 million. So that gives them enough confidence to enter into the small cap space. And this market cap about 5 years back was about $1 billion. So there has been a significant re-rating in terms of market bucketing for small cap, and that makes it very lucrative for a foreigner to look at India as far as small cap investing is concerned. And if you also compare it to emerging markets, we are in the $2 to $3 billion bucket. So average market cap of small cap companies in emerging markets is about 2 to 3 billion. So we have also now entered into that bucket, which makes India sort of fairly lucrative from a small cap investing perspective.
Very interesting data points you mentioned. So first, very interestingly, Bhargav spoke about is that the small caps have now got more free cash flows. Why the free cash flows have come? The free cash flows have come because of the improved supply chains. Why the supply chains have been improved? Because most of their raw material earlier they used to import is now being produced indigenously. During COVID, they changed the supply chains, and because of which their supply chains shrunk, and when the supply chains shrunk, the immediate impact was on the reduction in the working capital requirement. As the working capital requirement reduced, their profitability jumped, and that free cash flows got to pay the debt. And very interesting data point again, what Bhargav spoke about, 1.4 times debt to equity versus 0.2, 0.22 at the moment. So the debt free cash flows have been utilized to free up the debt. Now, this is past. What will happen in the future? The future is, currently we are at the capacity utilization for the small caps in general to the extent of 79%, as Bhargav stated. It's going to move. The peak utilization is at 85. Hence, more and more businesses in the small cap space in next 3 years from the free cash flow, because now already they have paid off the debt. So they are going to utilize this debt to create capacity. And that capacity utilization will essentially mean more bottom line. That's the game plan. That's the thing which one needs to focus on the small caps. Number two, game changing. Earlier, liquidity was relatively modest in the small cap space because of billion-dollar businesses. Now the same businesses have become $3 billion businesses or $2.5 billion businesses, which are equivalent to China, which are equivalent to other emerging markets. Hence, FIIs can compare, they can actually start looking at. Earlier, the thought process was FII means large cap. What myth Bhargav is trying to break, that now small cap, global small cap funds can actually look at Bharat, can look at India from their prism of investing into the small cap companies of today. So that's the second very macro game shift which has happened. Number three, he spoke about behavior of money. He spoke about psychology of money. He spoke about the thought process of money. So this government, I must give credit, people are now scared to default on their loans. The big promoters, earlier the thought process was, when promoters will come to the banks, they will come in a cycle. When they will come back to the banks to tell them the reasons why they can't pay back, they will come in Mercedes. That time, that day is gone. The promoters are now worried of their reputation, of prosecution in case if they are unable to pay their debt. And because of which there is good behavior, good timelines, good payment. Also, thanks to investors like yourself, thanks to the market investors who are contributing to the mutual fund flows, who are contributing to the direct investments in the equity markets. Those people have replaced to a large extent debt with equity. So SMEs who earlier were only dependent on debt are looking at SME bourse. The main bourse, earlier people were shy of coming onto the main bourses. They are now using that effectively. So debt has been replaced by equity, and thanks to the democratization of equity. So these are the three big themes on a macro level in the small cap space, which Bhargav taught us today, and which is going to make small caps relevant and pertinent, not from 12 months, 18 months, for next 5 to 10 years perspective. Thanks, Bhargav. This is very, very beautiful and concise information. Let's talk about your style of investing, your thought process on investment and investment management. You run a fund, you take care of a fund which is known as Emerging Giants. Emerging Giants, you constantly talk about quality, you constantly talk about Emerging Giants being the best in class in terms of numbers, in terms of business, in terms of the underlying company management, their integrity, their ethics, their corporate governance. What is this? Will it work? Because as you are saying, if the broad-based small caps will work, why should people not chase short-term returns? Why should people look at Emerging Giants? Why should people look at quality small caps? Because you always tell me that emerging giants means quality small caps. It's synonymous. Tell us about it.
Also, I mean, if you look at CY23 as a year, as far as small caps is concerned, and if you look at some data points as far as BSE 500 is concerned, it was a very abnormal sort of a year. It was a year where had you blindfolded yourself and just thrown a stone at any target, you would have hit the target. So if you look at the composition of BSE 500, there were 60% of stocks which gave you 60% plus returns.
Wow.
In BSE 500. And if you look at BSE 500 as an index, it gave you just 50% returns. So it was a year where essentially it was a free market and a free ride as far as money is concerned. This seldom happens because on an average, you don't have more than 15% of stocks in an index which give you alpha. And this was a year where 60% of stocks in an index gave you 10 percentage points of alpha, not just 1-2%, but 10 percentage points. Now, this kind of a situation seldom occurs. So obviously, during these times when the breadth of the index is very high in terms of performance, quality suffers. If you look at the top 20 percentage of BSE 500 stocks which have rallied in the last 6 months, surprisingly, what you will find is that many of them are companies which are loss-making. And many of them are companies which have given you a negative EPS CAGR, though profit-making, but negative EPS CAGR. So a lot of money has actually chased speculative bets. And that is what worries us, that whenever the breadth of the market gives you significant alpha, typically the following 2 to 3 years becomes a stock pickers market. And that's where sort of our role comes into play. Because if typically the breadth becomes very large, then you don't need a money manager to manage your money. It becomes totally a free ride. So best is to manage money by yourself rather than to give to a money manager. But unfortunately, that time doesn't last longer. So typically, what we do at Ambit is that in such a euphoria, we will never change our investment philosophy. We'll stick to what our basics are. So we love to play a Rahul Dravid kind of a game rather than a Jaiswal kind of a game where you just go and hit sixes. Because we know that hitting sixes on a consistent basis is not our DNA. We sort of more are singles and double takers. And we don't want to be very aggressive. And when I say aggressive, I'm talking about a 50% return. Our conservatism is equivalent to a 20% plus return. So 20% plus return is actually not a bad compounding. If you study any seasoned US investor, he'll be more than happy if you give him a more than 20% return. So essentially, what we are trying to say is that don't go by last year's return profile. Be very cautious. And today was a day where you saw a lot of sectors which were in flavor, seeing stocks going down 9%, 10%, 11%. In fact, emerging giants is not even down 0.5%.
Wow.
Today's carnage. So that is where you'll see sort of quality shine. And that doesn't make us defensive. So typically, what people say is that Ambit will do well during a fall and they will never do well during a market. But if you look at the earnings growth for our portfolio companies, it's at a staggering 25% in FY25 versus 22% in FY24. The return on equity at the portfolio level is at 21%. Compared to about 19.5% in FY24. And their portfolio is net cash. This is sort of leverage bets which played out last year. So it cannot be construed as a sort of a defensive company. And if you look at the CAGR since inception, it's almost at 17% post fees, which means at the gross level, we've delivered fairly consistent returns. And in terms of our investment philosophy, the first philosophy which we adopt over here is that we sort of invest mainly in market leaders, which are operating in a fairly oligopolistic kind of a market situation. To give you an example, Safari being a classical case study, it's just a three-player market, Safari, VIP, and Samsonite. And it's a fairly large addressable market at about $3 billion. What an oligopolistic market helps you is that it gives you revenue, it gives you pricing power, which means you make fairly decent EBITDA margins. And more importantly, it sort of gives you a healthy balance sheet ratio, which is return on equity. So these are the three basic things which you look in the company as far as investing is concerned. And that is our first model, that we'll pick up companies in oligopolistic kind of a market. Second philosophy is that we do extensive channel checks. That is, we will speak to the ecosystem, like the supplier, the distributor, the competitor, unlisted company, because that will give you a lot of flavor in terms of whether your thesis is playing out. So unlike sort of general consensus that you should just meet the management and go by what they say, we sort of also interact with the ecosystem to give you more granular view. Remember, we run a fairly concentrated portfolio. So therefore, to that extent, we need to be fairly convinced with our investment arguments. And the last bit is that Ambit is known for good and clean. So we have a proprietary forensic model where we look at 10 accounting ratios. Thankfully, we have a lot of chartered accountants in our team. So that helps us in terms of scrutinizing and doing a lot of data crunch as far as forensics is concerned. And that covers your P&L, your balance sheet, even your off-balance sheet items, which typically people don't look at. And alongside that, we also do governance check in terms of the board of directors, the senior management, etc., to give you more conviction in terms of the ethical aspects as well. So to summarize, we invest in oligopolistic kind of companies. We sort of look at our forensic and the governance angle. And the third bit being that we invest in fairly high growth companies. So it's not a sort of a defensive kind of a portfolio, unlike the general perception.
Fantastic. So, ladies and gentlemen, one very relevant and pertinent thing which Bhargav spoke about is that though the mood of small cap is buoyant, the visibility of the small cap as a segment, as a positioning is very, very robust. There are some places where the froth has been created. And one example which Bhargav spoke about is fairly simple. EPS growth being negative for last 3 years, for last 5 years. Profitable companies, but EPS growth being negative. And the stock price compounding over 20-30%. What does this mean? PE multiples just going haywire. So be cautious of that. Second very interesting point which Bhargav spoke about, that 60% of 500 companies gave what? 60% returns. What does this mean? And they are 10% above the benchmark, which means that it was a broad-based PE expansion which was unprecedented. Now, PE expansion happening to a certain extent, which means with a delta of 5, 7, 10% is fine. But when the PE multiples expand by 30, 40, 50, 60, 70%, you are getting into a frothy zone, because when it will come back to its mean or even little above the mean, the pain or the damage will be massive. Hence, look at companies which Bhargav manages or which Bhargav owns. And what he's talking about it, very simple, FY24 earnings at 22-23%, FY25 earnings at 25%. If you compound 25% over 10 years, you are talking about 9 times in 10 years. If my math serves right. On top of that, unlevered businesses, without leverage businesses, ROEs north of 20%, 21% ROE, unlevered ROEs. Unlevered ROEs at 21%, and free cash flows, positive cash flows, which means that is getting accumulated. And these companies are reinvesting back into the business for the capex or for the growth. So what Bhargav is simply saying is a simple aspect. He's trying to explain small cap is a fantastic space. However, the free rally, the free ride, the free opportunity is over. And today is one of the cases where he mentioned that the fund is not even down 0.5%, when most of the small caps are down 5, 6, 7% in terms of names, in terms of the sectors. So what one needs to be very, very categoric, stay in the small cap space, but shift from the poor quality into the good quality. That's all Bhargav is talking about. And how does he do it? Buy businesses which are monopolistic, which are oligopoly. You always have heard of this term, oligopoly, monopoly, constitute for the large caps. Bhargav has brought that for the small cap. Businesses where the industry is modest, growing rapidly. Industry size is modest, but growing rapidly. And there the companies have dominant market share. And the companies are growing at a very, very rapid pace. So that's the model which Bhargav does. And very, very deep down research, no secondary research, all primary research, figuring out what's happening inside the company, what's the moat, what's the defensibility, what's the sustainability, what's the runway for this growth. So that's the model which Emerging Giants maintains. Now, my next question is that when people invest generally in small caps and when the correction happens, they say we are all right with the correction because we have seen tons of money. So what's your sense? In a small cap, is it all right to take humongous amount of risk and have large amount of volatility and have humongous returns whenever the returns come, or consistency is better? What do you prefer generally?
So I've always believed that compounding will make you money. And what is more important in markets, it's not to make money, but it's to remain invested. So the mistake which people do is to follow a trading kind of a mindset. So my father also comes from a trader community, and he says that एक महीने में 2% बन गया, it's fantastic. And there will be many months where in markets you'll make more than 2%. Never think from a trading mindset, because if you start thinking from a trading mindset, then you will never compound your money. Why your money in a land or a real estate sort of compounds more is because every day you don't get to see a price or a price ticker. The difference is that in stock markets, you can see the price ticker, and that entices you to sort of sell it. Yesterday, we met an investor who had never seen his portfolio for the last 4 years, and we just happened to meet him and just show him the portfolio, and he says that I was very surprised that it's doubled in the last 4 years. Had I seen it 2 years back, I would have sold it off. So that's where essentially the power of compounding comes through. And if you talk to any retail investor, more often than not, whatever the markets in terms of index gives you as a return, the retail investor would have made lower than that. The main reason behind that is getting in out. That not only entails a transaction cost, but it also entails a missing opportunity. Many a times when during social gatherings, we all friends meet, there are different types of people, someone who's fundamental, someone who's a trader. Typically, you see people saying that 100 रुपए पे बेच दिया, आज 95 हो गया, सी आई मेड 5 रुपये. बट उसको एक महीने बाद मिलो and then just talk to him. He says कि यार 95 का 105 हो गया, मैं ले नहीं पाया, 105 का 110 हो गया, मैं ले नहीं पाया, आज 115 पे मैंने लिया है. So you missed out on that 15% leg up, right? So markets are in such a zone that it doesn't give you time enough to basically do entry and exit. My sense is that if you believe that we are in a secular bull market, and unless you don't require money for any urgent requirements, you should continue to stay invested. And my humble suggestion would be not look at stock prices periodically. If you just invest and forget, then that compounding will sort of become sort of a gold dust for you. And one day you will sort of, and what my learnings have been when I've traveled 26 countries in my career in Ambit and met a lot of portfolio managers, that invest like you want to give a legacy to your children. Don't invest for yourself. Invest as if you are going to leave a legacy for your kids, because the compounding then will play out. If you invest and you want to make money for yourself, then you will be a trader. But if you think like you want to leave a legacy for your kids, then you will become an investor. And that's, mind you, it's a very sort of a easy way to sort of make money. Just remain invested and you will make of the quality of companies in which you invest, because the power of compounding is fairly sort of humongous. You tend to read a lot on compounding, but actually many people don't practice in their day-to-day life. But believe me that essentially it's not that difficult. Just stop looking at the stock prices, and because if you look at stock prices, not only it will sort of make your life difficult, but it will have immense issues in terms of your health. Your BP will fluctuate, 4% नीचे है, 3% नीचे है. What's the point of नीचे तो क्या हुआ है? So never look at sort of on a daily basis. I would suggest look at on a monthly basis, because that will make you remain invested. Else, it's human psychology. When you look at stock price tickers, you tend to react. So the best is not to look at stock tickers. In fact, a successful batsmen in cricket don't look at their individual scores when they are sort of building an innings. Many a times they don't even realize that they have reached the 50 milestone. It's just the spectators clapping makes them aware that mera 50 run ho gaya. Because the idea is to basically win the match. And here, winning the match is basically leaving investments as a legacy for your next generation, and not to chase personal milestones like make a 50 or make a 100, because that is just an event. The outcome is basically winning the match, and in here, the outcome is to leave a legacy for your next generation.
Very, very pertinent, very, very relevant functioning of mind, which Bhargav explained. That think about that you would need this money when you are 60, or you would leave this legacy after you are dead and gone. So if you have such kind of thinking, then you will not look at constantly, and especially in the small cap space, which can be rather volatile, which can be rather fluctuating at all points in time. One day it can be down 6-7%, and one day it can be up 6-7% as well. So rather you should stay away, because you may not be able to capture all of it. And remember, a lot of people believe that trading is a great way of spending time. The collateral damage to this, and as rightly pointed out by Bhargav, is on your health. Subconsciously, you get so emotionally attached with making money or losing money that it impacts your emotional health. And this then reflects in your family life as well. So let the money manager, let the fund manager, let the investment manager whom you have trusted do the job, and trust with him for 3, 4, 5, 6, 7, 10 years, rather than constantly churning. And most investors, that's what they do. Before investing, they take 5 minutes. After investing, they take 15 minutes. So you should do reverse. Spend time with the investment manager, spend time on the business, 50 minutes, 5 hours. before investing so that you know everything about the business, about the investment manager whom you're trusting with the money. Once you have given, once you have trusted, leave it for 5 years. So 5 hours prior to investing, 5 years after investing. That should be your focus. My next question, small cap is very, very diverse. Small cap. So in large cap, we generally talk about sectors. We talk about commodity sector is doing well. We talk about BFSI is doing well. Sometimes we talk about PSUs are doing well, etc., etc. Do you have any thought process of what is going to work in 24, keeping in mind that government is still bullish on the capex? There is quite a bit of certainty, as you also rightly articulated, that after the fantastic Ram Mandir consecration and after Ramji coming back 500 after 500 years, Ram Mandir getting constructed, there is a certainty that the incumbent government is going to come back. And if that were to happen, there is political stability. So which sectors, from your perspective, especially in the small cap, will be the future?
So, theme which one can look at is exports. So, if you look at Indian electricity rates, labor wages, and you compare it to China, then we are almost 40% cheaper as far as electricity and labor wages is concerned. And now that the government is signing up a lot of free trade agreements, we signed up with Australia, we signed up with Middle East, we are fairly close to sign up with UK, and maybe in the next couple of years with US. You will see benefits on the equipment purchasing side as well for Indian entrepreneurs in the form of concessional import duties, concessional custom duties. So India will become slowly and steadily a manufacturing hub for a lot of MNCs. We are seeing such activities across a host of sectors, and it's just a starting point. We've seen that in mobile phones. We'll possibly see that in laptops. Going forward, we might see that in footwear. So I mean, exports as an opportunity will emerge. Big theme, and herein you will find a lot of small cap companies also coming out. In fact, you'll see many IPOs also in these export sectors, which will come through as the time passes. The second theme which you might want to look at is the building material theme. If you look at real estate as a sector, has done well, and that is on the back of real estate companies doing extremely well. Launches have happened, unsold inventory is now at almost all-time lows. And what that means is that once these houses are going possession and people start moving in, you will see a lot of building material companies getting business. Last couple of years have not been that great for building material as a sector, which has a lot of subsectors like wood panel, electrical goods, ceramic companies, sanitary companies, tiles, paints. So a lot of these companies will come into action again as people start occupying these houses. So that is the second theme which you might want to look at. The third theme which you might want to look at is the rural theme. So last 3 years have been very difficult for stocks which have a large part of their businesses coming in from rural areas. But if you look at a few data points in terms of rural, we are seeing falling unemployment across a lot of rural areas, especially in the last 8 to 12 months. We are seeing commodity prices cooling off, and resultantly, companies will cut prices. So one of the reasons why rural was slowing down is because of the hyperinflation that we saw during the COVID periods. But now possibly we'll enter into a cycle where you will see companies cutting prices. Yesterday we saw paint companies cutting prices by as high as 2 to 3%. So that augurs actually well for And typically, in the election year as well, the government is also having a soft corner towards the side of the population. So you will see some sort of freebies also, which could get doled out. More so, many of the rural people had savings getting eroded during the COVID period, but now that is starting to sort of come back. So rural as a theme can also become interesting. Early signs of that are visible in a few subsectors like two-wheelers, where we are seeing a strong comeback as far as CY 23 is concerned. So yes, that is a third theme which you might want to look at.
Very interestingly, so unconventional themes. So you have got building materials, because as Bhargav pointed out, there are roughly around 3 crore houses which have been delivered by the government, and there are more to be delivered in next 2 years time frame. And these are low cost housing as well as mid cost housing. Plus real estate, we all saw that the real estate sector has done extremely well, which means that people are buying high end houses, so they would require a lot of inner furnishing. So that's one sector, industry, the domestic supply requirements, and also includes your durables, consumer durables as well, white goods as well, electricals as well. So all of that, the demand will be very robust. Second, he spoke about uh, everybody talks about China plus one. Now I talk about China being Bharat plus one. So now Bharat is a place where everybody wants to come and import from. So you are going to see, as China is decelerating, the 5-year return in the Chinese stock market have become negative, and negative by a mile. It has become 30-35% negative for a for a 5-year period in China. Interestingly, the price to earning multiple of the Chinese index is equivalent to the price to book for the US stock markets. So that's the correction which we are witnessing in the Chinese market. So the exports theme, and with little bit of things murmuring about COVID new variant, which is again going to emerge from China or who knows from where. There again, people are constantly talking about supplies being coming from Bharat rather than from China. So export theme is the second biggest theme, which the small cap. So rather than sectors or industries, what Bhargav is focusing is on the themes. And the third big theme is the rural. Rural has been the pain point consistently for the government as well as for the markets, that rural demand is not picking up. And this time, as Bhargav spoke about, that the wages have gone up, the rural unemployment has gone down tremendously. It's approximately all time low. The Manrega demand has come down. So the want of Manrega money has come down tremendously, and that clearly states that rural demand will drive the economy, followed by stable government, followed by capex, the multiplier effect of capex, and followed by renovation, rejuvenation of the military weaponry, which is constantly happen. There is tons of money to be made in the small cap space. So this is what today's webinar was all about. Any final words, and then we'll summarize and close. Any final words from your end, Bhargav, as a piece of advice? Final words from you.
So final words are that it's a promise from our side that we'll come out with very high quality newsletters, which will help you in terms of reading a lot, will be fairly data backed. Second is you will see such kind of webinars happening very consistently, and typically promises are made in the first month of a calendar year. So we are also following that tradition, and it's a commitment from our side as well as Siddhartha that we'll do it in a fairly consistent manner. And third is that we'll always be at your service. Last 6 months have been difficult for us given the broad-based rally, but we've always stood by in terms of any queries you have. We've taken all the abuses. As Modi said that every minute he likes to eat galis. So we are also sort of following that prediction. Our time will sort of following that prediction. Our time will come. Give us sort of your patience. We don't want anything else. Just be patient with us. Your money is in safe hands. We'll never sort of invest in companies which will sort of bomb out. At least have that trust in us and be patient. So that's the closing remark from my side.
Thank you, Bhargav. Ladies and gentlemen, remember 2024 is the year of stock picking, is the year when one has to do bottom fishing, one has to go deep into the waters and figure out the quality businesses, because that's where the alpha will get generated, and that's where the promise of investing and generating consistently good returns comes from. So 24 is the year of emerging giants. Stay invested with us. Also, if you want us to cover any particular topic, any particular sector, any particular industry, our research team will do a fantastic job. We will cover extensively. You can write to us at amsales at ambit.co. amsales@ambit.co. If you want us to cover any particular topic, what we will do is we will bring those conversations through our webinars, through our newsletters, because we understand investing is one part, knowledge is second part. We want to combine both of it and want to bring the best to you, because we are known for it. We are known for our deep dive research. We are known for our quality research and understanding. And that's what we can bring out to you. Remember, the returns can move up and down in the short term, but what works in the long term is compounding. And we are strong believers of compounding. Jai Hind and Jai Shri Ram. We will see you once again in another webinar where we will talk about the other funds, other investment opportunities, other stocks, other sectors, other themes. And as I mentioned, we will cover some of your themes. It can be AI, it can be Web3, it can be blockchains, it can be anything. It can be climate change, it can be organic industry, anything. Whatever you want us to cover, we will do it. Thank you. Jai Hind and Jai Shri Ram.
Thank you.